The younger you get started, the more money you're going to make. But how do you get started?
Hey, I'm Alex.
And I'm Philip.
And we teach you what you need to know about being a grown-up.
Because adulting shouldn't suck. If you're new to this channel, make sure you hit that subscribe button. In the comments below, let us know if you've started investing or not.
Okay, so this video is going to be broken down into 3 different steps. The first one is just deciding that you're going to start investing at an early age. The second step is deciding how much money you're going to invest. And then the third step is actually starting and opening an investment account. And then after that, then we're going to break down in English all the different things like ETFs, stocks, bonds, mutual funds, all that stuff that you need to know that is usually super complex. We're going to try to simplify it as much as possible. Talking about investing is like a whole different language. There's like financial education, and then there's like alien language, which is investing to most people. So we're going to try and simplify it and make it as entertaining as possible. And a quick disclaimer, we are not financial advisors.
Nope.
Probably why we're not boring, but we're not giving you financial advice. We're just giving you general knowledge about investing so you can take that knowledge and build on it, and then hopefully make yourself some good money using some of that knowledge.
The earlier you start investing, the more money you're going to have when you're older. If you can get started like right out of high school, that's going to be great because that money over time is going to grow to be huge. But right when you first getting started as an adult, it might seem impossible to be able to pay all of your bills like rent, utilities, gas, car payment, car insurance, all that type of stuff. Once you do get a budget set and you actually have some money left over every month like you're supposed to with a budget, you should 100% start investing. But don't forget about an emergency fund. You need to have an emergency fund. Because if you don't, when that emergency happens, how are you going to pay for it?
Yep.
Yeah. And you're
Better not put it on a credit card.
I'm going to take it on this credit card. I'm going to borrow money from my Grammy. I'm going to take money out of this investment thing over here. All bad juju. Don't do it. If you don't know how to set up an emergency fund, we have a video on that. The link's going to be in the description below. But emergency fund, when you're just getting started, is supposed to be 3 months of all of your expenses saved up in an account that you only use for emergencies. The overall goal is 6 to 12 months, but if you're just getting started, 3 months is what you need.
The tricky part is trying to figure out how much money you should invest or when you should start investing. And I know everybody and their mom, if you even tell them that you're thinking about it, is going to have advice. Whether they're a financial professional or just some dude who bought a bunch of AMC and GameStop, everybody these days is going to be an expert and tell you what to do with your money. That's just how life rolls. You get a bunch of money, people are always going to help you spend it. Now, your first question is probably, how do I even get started? And then after that, it's, what's the best investment strategy for somebody who's a beginner or a newbie?
The best strategy? Oh man, that's getting started as early as you possibly can. That's going to allow you to see massive returns on the money that you invest because of compound interest. Compound interest is going to allow you to gain interest on the interest that you put into your investments. Think of a snowball rolling down a hill. As it goes down the hill, it accumulates more snow and gets bigger. This is what compound interest is doing to the money that you invest. The longer that snowball is rolling down the hill, the more snow it collects and the bigger it gets. That's what's happening with your money over time in an investment account.
Okay, so one of my favorite things in order to see that snowballing effect that Philip was talking about is going to bankrate.com and using their investment goals calculator. And you can plug in however many years you want to invest for, right? So if let's say you get started at 20 and you're going to invest until you're 65. That gives you 45 years to invest and build your wealth, right? And say you're 20, you don't have any money, so there's no initial investment. And we're going to say you get a 10% rate of return on your investments because that's industry standard for stocks. And I don't know, you can't afford a whole lot, but you're going to start out where you can, and that's $50 a month. All right, so $50 a month for 45 years, that's assuming you never make any additional money than what you're making right now to be able to put away. At the end of that 45 years, you would have $450,000 approximately if you got 10% average over that 45 years, which 10%, it's not great. It's not bad. That's just the average. So At $50 a month, if you get started when you're 20, it could be $450,000. Now, let's say you got started at 25 instead of 20. So you only had 40 years for your money to accumulate. Okay, 5-year difference because, I don't know, maybe you're in college or maybe you're just working part-time or full-time minimum wage and you tell yourself you can't afford putting away $50 a month. So you get started at 25. So you only have 40 years for that money to accumulate. Same money, different outcome by almost $200,000. You only make $277. I mean, that's still a lot of money, but that's a huge difference because you chose to wait. That's why Philip keeps saying time is on your side. The best investment strategy is now. Get started. I don't care if you're 18, 22, 30. If you haven't started, right now is when you should start. So let's go back. Say you're starting at 20, so you got 45 years for your money to build, and you put away $100 a month. Boom. That's almost $1 million. That's $900,000 from $100 a month.
You might be thinking that $100 a month is a lot of money when you're 18 and you're only making a minimum wage. And it might be. So do $50. But the point being is, once you get older, you should start investing more money. If you're making $75,000 a year and you're only investing like $100, shame on you. There's going to be ups and downs in the stock market. This is a long game. It's going to go like this, right? But it's going to go up. But it's going to have its ups and downs. A good example, 2020, mine went like this. And I was like, woo! Right? And I was like, oh no! But I left it there. Okay? The next year came and it was like, grew 78%. It was crazy. It was wild. Ain't never had numbers that high before, but it happened. But if I would have pulled out all of my money, it wouldn't have grown. And I'd have been like, oh no. So, long game, remember that. It's going to have the waves. It's going to go like this. Just ride them. Put the money away. Don't even look at it. Let it go.
If you just save your money, not only is your money not going to grow as if you had invested it, but the purchasing power of your money over time is going to be less and less because of inflation. And so we're actually about to screen share an inflation calculator so you can see exactly what inflation does over time based on the devaluing of the dollar or wherever you're at. Okay, so here's an inflation calculator from nerdwallet.com, and it's just showing how inflation erodes your money. So this calculator is just for normal inflation, by the way, which is a lot less than what we're currently experiencing here in the United States. So let's say you bought something in 2021 for $100, and then you went to go buy that same item 10 years later in 2031. That same item for $100 would cost you $128. So 28% more. And then let's say you went to buy it 15 years later. It cost you $144 for that $100 item that you bought in 2021. So the point of this is, over time, your money buys less and less, and that's why it's so important to invest your money, at least to be able to outpace inflation. Because inflation, like it says in the calculator, erodes your money over time and your purchasing power. So what you could have bought in 2021, in 2036, it costs $144. That's $44 more than what it was. Now, real quick, let's say 2021, you're 20 years old. So 45 years later, that's what, 2066? In 2066, that $100 item would have been $303 on normal levels of inflation. So 3 times the price when you get old than when you're 20. So you have to invest your money in something in order for your money to keep growing. And that way you have enough money to actually live on when you're old.
Just so you guys know, the average rate of inflation is 2 to 3%. Just to give you guys another example, in 1990, the average house cost $79,000. Today, in 2021, that same house would cost you $408,000.
Ugh.
Disgusting.
We were just talking about, I don't know, a couple days ago, about how a $500,000 house when we were a kid is not what a $500,000 house looks like now. They were like a mansion when we were kids.
Yeah.
And now that's like at least $1 million house, if not more.
I know. We're not going to get deep into the topic of inflation here. We just wanted you guys to know that your money is going to lose value over time, which is why it's so important for you to start investing early so your money can grow and grow and grow.
So the next thing is deciding how much money to invest. And this is going to depend on your age, how much money you have that's disposable that you can actually invest that's not going to hurt you in other areas, what your investment goals are, and then at what age you want to reach those goals. So the most common one is retirement. That's the most common reason why people invest. There's a lot of other reasons too, like maybe you want to invest and save up money for a vacation, or you want to invest and save up money for a house. I don't know. Everybody has their own goals, but those are some of the most common ones. And when you start really depends on what your age is, how long you have to save up, and when you want to start pulling that money out. Most financial experts are going to tell you that you should aim to do 10 to 15% of your income for investments, and then as you make more money, go from there. Now, what if you don't have 10% left over because you're just starting out and paying rent and bills and buying food and all that other stuff is freaking expensive, and it's hard to live on minimum wage or maybe just a little bit more than minimum wage. So you can't do 10%, so you just say, screw it, I'm not going to do it. I can't do 10%, not good enough. I'm not going to do it. I'll just wait till I get older. Bad idea. Hopefully that investment calculator and what Philip and I have been talking about shows you otherwise. So if you can't do 10 or 15%, like we said, do $50, do $100. If you can't do that, do $25. I guarantee you can find $25 somewhere and start putting it away. And at first it'll feel like nothing, but over time, that compound interest will add up and add up and add up. And eventually your financial situation is going to change. You're going to make more money. You can do more than $25 or $50. And then you're going to see it snowball. So the best time to get started is now.
Opening an investment account. If your employer doesn't offer a 401k, you can still open up a retirement account. It's known as an individual retirement account, aka an IRA, and they're going to have the traditional and the Roth versions. Quick side note, if you're not investing for retirement, then you're not going to want to set up a retirement account because you can't withdraw your money early. If you're trying to buy a house and that's what you want to invest for, these aren't what you want because there's a big old penalty if you withdraw your money early. If you want to invest for like a house or something else, like a college fund or your kids, then you're going to want to create a tax brokerage account. That's going to allow you to pull your money out at any time without having to get those big old fees and penalties. A common misconception is that you need a lot of money to start investing. But that's only really true with certain big companies. There's a lot of companies out there that allow you to start investing with no minimum requirement to get your account open.
So what is a brokerage account? It's a type of account where you have access to the stock market and you can buy and sell stocks, bonds, mutual funds, and ETFs. And the big difference between a brokerage account and a regular bank account, because you can transfer money in and out of both, except a brokerage account gives you access to the stock market. That's the biggest difference. You'll also see a brokerage account referred to as a taxable account, which is what Philip used for terminology a second ago. They're interchangeable. They mean the exact same thing. All it means is the money that you're making in those accounts is taxable at capital gains taxing rates. And those are things like, or they're apps like Robinhood, Webull, Ameritrade. And those are some of the most common ones, but there's a bunch of different types of brokerage accounts. Retirement accounts have entirely different tax and withdrawal rules. So if you're looking to save up money for retiring or saving money for retiring, then that might be a better account for you. Like I said, we're not licensed professionals, so I can't tell you which one's better, but they're used for very different purposes.
Next question, how do brokerage accounts work? Many brokerage accounts, they can be set up online and they typically don't require any initial deposit. You just have to put some money into the account before you can make any purchases or investments. And typically the way that you're going to do that is you're going to have money transferred from your savings account or your checking account or another brokerage account. You own the money that's in the brokerage accounts and the investments, and you can sell them at any time. There's no limit on the amount of money that you could deposit into these taxable brokerage accounts online each year. So you got money, send that.
For most people, investing in a 401k through your employer, if they offer one, is the easiest way to invest for your future. That's what we've been doing for years, about a decade now, and it's easy. It's a no-brainer. You put money in there, you choose what kind of funds you want it to go to. We use the TSP, which is a government version of a 401k, and you just choose how you want your funds to go, and then set it loose. And it makes money, hopefully. I mean, we've been doing pretty good with it. But a lot of times, if you have a 401k, you can choose some different portfolios, or you can hire a professional to help you manage it. Depends on how much money you got, I guess. But the other way you can do it is through a brokerage account. But if you don't know much about trading or day trading in stocks, you can lose a lot of money doing that.
Oh, yeah.
We're still learning on how to do that stuff. Thankfully, we've been making money with it, but for the most part, it's a lot more risky than putting money in your 401k and then just letting it grow for 40 years. If you work for a company that has the 401k as an option, a lot of companies will do some kind of matching. So if you put in 5%, they might match up to that 5% for a total of 10%, and you only had to come up with 5% of it, which is awesome. So we definitely recommend taking advantage of that if you work for somebody who offers that. And just because you have a 401k doesn't mean you can't open up a separate IRA. If you've got the extra money and you can do that, absolutely. I mean, the more investments you can make, the better. So like I said before, depends on you, your goals, how much money you have, and how much time it's going to take to get to where you want to go. Okay, so the next one is going to be a mutual fund. And a mutual fund is just a package or a portfolio, whatever you want to call it, of bonds and stocks. So instead of investing in one stock or one bond and putting all your hopes and dreams in those couple of things, this spreads it out across dozens or hundreds of stocks and bonds. And so your risk is a lot lower, but your gains aren't typically going to be as high as if you had invested in, I don't know, Tesla, and then it went to the moon, or AMC or something, where people think that it's going to blow up and make them millions of dollars. Typically, in a mutual fund, it's not going to do that, but you're going to make money, but your liability or your risk of losing money is a lot lower too. So with these mutual funds, usually they are managed by a professional company, and you have to pay for somebody else to manage your stuff. Now, if you don't know what you're doing, might not be a bad option. We, through the TSP, have what's called index funds. It's a category of a mutual fund, and it makes it so you can manage that stuff yourself. And we've done pretty good. I haven't had less than 15% gains in, I don't know, since like 2014. He had over 70% returns last year. So we're doing pretty good managing it on our own. I mean, that was crazy impressive. I don't think I've met many people that have ever done that. So, but just know that index funds are a type of mutual funds that you can manage on your own.
Exchange traded funds, aka ETFs. An ETF is a whole bunch of individual stocks all piled together. And you can buy these at share price, which is great because you can typically buy this at a lower price than what you would a mutual fund. And that's great for those small budget investors or new investors.
You got to pick your investment strategy, and it all really boils down to how much risk are you willing to accept, and how old are you, and how much money are you going to be putting towards this. So if you're young, let's say you're 20, 25, maybe 30, you can put your money in a higher risk category because you want to have higher returns. Like his stuff, to make 78%, was in like an ultra high risk category in order to make that kind of gains.
I love living on the edge.
Like I'm a little bit older than him, so my stuff is a little more scaled back and conservative, and I made, I don't know, it was like 19.5%, which is still great. But if the stock market had gone the other way, he would have lost a ton of money, and I probably wouldn't have lost nearly as much. But the point I'm getting at is when you're young, time's on your side, you can afford to be more risky and get bigger gains. And if you screw up and you lose a bunch of money, well, you got a lot of years left of working to make up for it, and you can recover. Whereas somebody who's like 50 or 55, they're going to put their investments in something probably a lot more conservative because they don't want to lose the nest egg they just spent their whole life building right before retirement. So risk versus reward. How much risk are you willing to accept? Because the more risk, the higher rate or the higher potential for gains, right? Mine was less risky. I didn't make as much last year, but I still made good money, but I didn't want that much risk.
Picking a particular stock can be super hard and complicated and time consuming. That's why it's best for the new investors to go into those mutual funds, those ETFs, and those index funds. We have a recruit that we put into the military when she was 18 years old, and we set her up on that high risky stuff like I'm on. And she's 23 now, so she's been doing it for like 5 years, almost 6, and she's got 6 figures invested already. which is more than most people we know our age. I mean, yes, it's on the riskier side, so if something happens, then it could tank, but she's young and she's got time on her side to recover if that does happen.
All right, so the last step is opening up a brokerage account. Now, you can do it online. Usually it takes less than like 15 minutes, and if you're over the age of 18, you can open up an app on your phone. You can have multiple apps on your phone. You can go to a bank and open up a brokerage account. If you're under 18, tough luck, can't do it on your own. Got to have your parents. Now, in order to open up a brokerage account, you have to set up, like Philip said earlier, you have to link your bank account to it or another brokerage account and make a transfer to fund it. And then once that transfer is complete, boom, the setup process is complete, and then you can start investing.
You'll probably have the option for either a cash account or a margin account. You're going to want to stay away from the margin accounts, okay? Plain and simple. They're complicated, they're risky, they're dangerous. Just don't do it.
Not until you learn more.
I mean, a lot more. Like, we don't even mess with margin accounts, okay? We ain't even going to talk about them. So just remember, cash accounts. Margin accounts, bad. Don't do them. If you like this video, hit that like button and don't forget to subscribe. In the comments below, let us know what your favorite part of this video was.
And we'll see you in the next video.